Well, yes, we have revised up a little bit. I mean, we're finding a very steady growth path for last year, this year, and next year. Actually, 3.2%, exact same number for all 3 years. And I think when we do the risk assessment around that baseline, the chances that we would have something like a global recession is fairly minimal at this point. It would take a lot to derail this economy. So there's been tremendous resilience in terms of growth prospects. We've seen the US doing very, very well. We've seen a lot of emerging market economies doing better than expected. There's been a little bit more weakness in the euro area, but overall it's been performing quite well in the context in which inflation has been coming down faster than expected up until very, very recently. And so it's a set of good news overall.
And let me turn to inflation then, because the biggest task for central banks, according to the report, is to ensure that inflation continues to decline smoothly. You've warned against both prematurely easing and delaying policy too long. Is it fair to say there's huge execution risk from here for central banks?
It varies by region. This is one of these themes that we emphasize, these divergence themes. I mean, when you look at an economy like the US, there is a sense, and we document this in our report, some of the inflation dynamics right now in the US are propelled by tight labor market, strong demand. And so, therefore, from the point of view of the Fed, they have to be very careful that this sort of tightness, strong demand is not something that will stay, because that would potentially lead to a delayed disinflation or even reacceleration of inflation. You look at the euro area or the UK, and you find a situation where there's no evidence that the economy is running hot, not at all. So in fact, you have a disinflation on the back of energy prices coming down, the pass-through from this decline in energy price into core inflation. And there is a sense in which they could be in a position to ease earlier, maybe than the Fed. So I think we're getting to the point where we're going to see differentiation in monetary policy going forward. In our baseline, we expect all of these regions to start easing in 2024.
UBS was debating the other day what happens if inflation gets wedged at 2.5% or higher, saying that it really risks the ability to get past the last mile story, and saying that it could in fact steer the Fed back towards lifting interest rates next year. 6.5% by mid-2025 was one scenario. Could we see the Fed still pivot and raise rates from here?
I mean, of course, one can imagine a number of things happening. This is certainly not in our baseline. Our baseline, as of now, is that the Fed will cut rates to about 3 cuts between the end of the second quarter and the end of the year.
You're still thinking 3 after the hot data points
That's
from
our
jobs
baseline.
to CPI and retail?
This is our baseline, and some of this was locked in before some of these latest numbers came in. If we factor them in, there could be a sense in which some of that easing might be delayed a little bit, but we're still seeing a trajectory where inflation continues to come down and activity remains robust. What we're seeing when we look at inflation right now is there is still an inflation problem, if you want, when we're looking at services inflation, especially services outside of shelter. And so this is where we need to see more progress going forward.